Hello, everyone, and welcome back to the J22 Report. I am your host, Johnnie Market. You all know that drill. Smash that like button, subscribe if you already haven't. Remember the disclaimer: nothing should be construed as financial investment advice. Just my opinions, thoughts on the market. Read more below. Let's get into the weekend stuff. I was Friday. I took the day off, or took some time off, but you can tell. Consumer sentiment really down 57.9, 63.1 was expected. Inflation above expectations 3.9, 3.5. So you can tell people are souring on the economy, as we can tell right here. Where is it? America's sour on the economy is highest as inflation expectations hit its highest since 91. That is a pretty big deal. Why is my computer not? So, having some computer problems here. But yeah, basically, if you look at this in terms of the inflation numbers, all right, now it can actually drive. So, look, elevated price increases, top concerns, and tariffs, they say. But I don't think tariffs are, maybe they are because they're in the news, but look at that. Lowest since November 2022. So yeah, this could be like the 2022 bear market this year. And then there's the big stimulus and there's a blow off top. I don't rule that out. Pessimism on inflation soared again. So you can see that the economy's horrible, sentiment's bad. Now, I think with interest rates, the Fed funds rates being where it is and whatnot, I think rallies will be capped for now. I think there's a big stimulus and maybe a blow off top where the S&P goes back to 6,000 or 6,500, or I don't think it'll break 7,000, at least not now, maybe ever. Never say never. Maybe probably in my lifetime, it probably won't break 7,000. But we'll see what happens. You never know. Don't rule anything out. But here's the things with the economy. This got on reading this. Credit card debt is getting in the way of saving for many workers nearing retirement. See, and this is going to keep wages down because people can't retire. I talked about how this credit card bubble is going to really devastate the economy. And so many adults 50 and older carry credit card and debt use credit cards to pay basic living expenses. So, gosh, these Yahoo Finance articles, why can't they just stop doing videos? Like, can't people just read? Like, it slows. I'm gonna get it down. It's gonna come. But yeah, why can't people just read? Maybe that's, do they always have to watch? I read a lot. Well, I haven't read lately, but anyway, once again, this is slowing down. But yeah, this is a big problem for people, and I think it's going to accelerate in the future. I think they're trying to refinance the debt, but anyway, yeah, that's the thing. Credit card. I hope I can get back into that Yahoo Finance credit card. Let's see if I can get back in. It just keeps uh if I can let's see if I can let's see. I'm gonna try to get back into it so I can read it. But yeah, I've been having credit card. Let's see, where is it? Credit card debt. So yeah, for whatever reason, it just did not. Let's see, did not. So yeah, many 50 adults because there were some overwhelmed by out of pockets. Saw their debt load go up. Look at this. I wasn't able to make ends meet, and let's see. This. There was very something very 3 in 10 older adults have more than it was a year ago. So yeah, you all this stuff you hear about boomers accumulating all this wealth, don't believe it. They're just trying to create. division right now. Everyone in America is really poor. And it's because of asset prices, though. Yeah, so it's many older Americans with credit card debt hope to retire soon. Will have to make a decision whether to pay down their debt or save for retirement. I would say pay down your debt. Interest rates are only going, not financial advice, just my opinion. Interest rates we're in the new cycle where interest rates are going higher and higher and higher. I mean, remember, nonlinear, fractal in nature. It's not going to go all up at once. But and so yeah, a lot of people 7 in 10 retirees reported debt, having credit card debt outstanding. So, and here's what it is: rising groceries, housing, and vehicles. I've talked about these: the housing bubble, the vehicles, the cost of groceries. So, and this is one. The other one is a lot of people are rating their retirement accounts, and I would actually do this, make this policy that your retirement accounts you can withdraw from any time. You need them to pay down debt or whatnot, then they should be able to do that. So. They shouldn't have to loan against it or whatnot. Look at this. 1 in 5 are expected to take more than 5 years to pay it off. And this is uh so look at this. Decision to pay down debt or save for retirement. Can't retire with massive amounts of credit card debt. So look, that's very interesting. The credit card debt, this is a bubble. Uh this is a bubble. Yahoo Finance, let's get rid of that. Other thing, has US fallen into recession? This is a good thing. GDP growth, talked about this before, 1.6 in quarter 1, according to Atlanta Fed GDT. But here's the thing, adjusted for gold imports, it's 0.4%, so it would be higher. Now, in my opinion, how they should track imports and exports is, let's say you exported $20 million of goods, but you exported 4 million of gold bullion, then I would count exports as 16 million. I would do exports minus gold because when you export gold, you're exporting wealth. And I would do the same with imports. Let's say you imported 25 million worth of goods, but you imported $10 million worth of gold. I would say 25 million minus 10, and you have 15. So yeah, that's how I would do it. If you exported gold but imported exported gold, I would actually take that away from exports because you shouldn't be exporting gold. But if you're importing gold, I would take that away from imports because that's gaining wealth. And one of the reasons we had this big boom after World War II is we were importing so much gold before it. So gold should not be counted. Uh, so that's and regarding the auto loan bubble, I talked about this, but auto insurance prices are rising, and this will get people to sell their cars, and they'll be like, I don't have to pay insurance, I can just pay off. And this will really hurt people. So auto insurance, this is a bubble that's really hurting, and auto insurance prices, they're starting to climb even more. That's not gonna stop. Here's the other thing. I'm going to talk about this a little. Gold reaches 3,000. So if you look at this, does 3,000 count? In my opinion, no. It doesn't count. It was done after hours. You couldn't really sell your gold equities at that price. You couldn't really sell your bullion at that price because, your coin shop, or if you buy from Atmex or JM Bullion or anything, they're closed. Can't sell it till the next day. So, my opinion, I mean, after hours, to me, that doesn't count. What is it on the open and what is it on the close? And that's my opinion. It's not, I don't count. Gold has not, in my view, has not hit $3,000. That's just my opinion. If you can't sell it, you can't. It's just an imaginary number. It's a fake number. I do think gold's gonna get to 3,000 and break, but in my book, it's not. Feel free to disagree. But this is another reason, though. I'm just looking at this title, why I like the miners. Newmont, why I like gold, but not miners. Sentiment, despite gold being 3,000. Look at this. Newmont, 46. Up. Let's see. Just go to finance. Look at Newmont. Newmont's like even considered one of the bad ones. They always say it's poorly run. But yeah, today 1.29%, even though gold was down. 5.4%. It's up on a 5 day, 1 month down 0.64. 6 months, 13. God, Newmont is garbage, but year to date, 24%. But yeah, so if you look at it, they don't, no one likes the miners still. And so, in order for the sentiment to be a top, that's good sentiment. I think the miners will do well. Quick thing on the stock market. I think it's due for a bounce. 5,600. I think there'll be I think rallies in this will be capped just because interest rates, like the Fed funds, they're not cutting rates now. And look at the CBO. This is 10-year. Interest rates compared to debt levels, 4.3. They're still high. Now on a 5 day, over 1 month, 3.67, but on 6 months, up 18%. Remember, nonlinear and fractal nation. I expect interest rates to be flat to bottom this year, but we'll see what happens. But anyway, that's all I have. Gold looks good. I think it has the rest of this year, maybe next year, to do really well. And then I think there'll be force majeure. Uh, but yeah, I think a big stimulus. I mean, right now they're gutting the government, they're gutting. But I think what's going to happen is there's going to be a recession and they're going to try to monetize the debt. And there's going to be interest rates will drop to zero, refi, and they're going to have a big stimulus boom. And then inflation's going to be ratcheted up. And so right now, who knows? One of these bubbles might pop. It might be the auto loan. I expect it to be the auto loan first, but commercial real estate, a lot of these others, it's going to get ugly. So anyway, that's all I have to say. Hit that like button, subscribe, and this will be caused by the consumer breaking. It's almost broken, but it's not yet. It'll get lifeblood from this stimulus, but it's like a crack addict. Give it some crack, they're going to go into withdrawal quicker. So hit that. That's all. Remember, not financial investment advice, just my opinion. Hit that like button, subscribe. And if you watched all the way through, thank you. So see you next video.